Welcome back to my channel, Balance Sheets Matter. In this video, we're going to be doing a stock analysis on Procter Gamble, ticker PG. But before we get into the stock analysis, of course, make sure to subscribe to my channel, Balance Sheets Matter. I do individual stock analysis videos, so if you like looking at good ideas on potential stocks to buy, value traps to avoid, make sure to subscribe to the channel and also like the video. And if you do want me to look at a stock, you can leave it in the comments below. Since Procter & Gamble was a subscriber request, and that is one of the reasons we're basically doing the stock analysis on it today. So getting into the stock analysis here, the first thing is check out just some of the top overall metrics to see where basically Procter & Gamble is sitting. Sometimes for more predictable companies, which I would kind of classify Procter & Gamble as, this little group-focused value band can be somewhat reliable. It is showing it's maybe a little bit marginally undervalued, but not tremendously compared to where this is looking at. And then the next thing we can see, the PE right now is sitting at 20.66, and the forward PE is only marginally lower at 19.99, implying there's going to be only a little bit of EPS growth going forward. And they do have a modest dividend yield of 3%, so we're going to be seeing those dividend basically investors if this is going to be a sustainable yield and if we should expect to be raised in the future as well. And it does have a payout ratio of 0.61, and there basically is a very small 3-year average buyback ratio of 0.7 as well. Now diving into the 30-year financials here, the first thing we can see basically on the revenue trend here is the blue line is the average overall and the green line is the actual realized one, and everything kind of on the blue here going to the right is based on the analyst estimates. So the average overall trend overall of their revenue growth has only been about 3.24% per year. So this is one important thing to realize about a company like Procter & Gamble is their growth is very slow. So that we really do have to factor that in the analysis there. And based on the analyst estimates, they are probably expected to kind of grow at about that rate. But once we start factoring in buybacks, basically, it's a little bit higher on a per share basis. In the last 10 years, they've averaged about 4.5%, with the EPS exceeding that actually by quite a bit at 7%, which I'll kind of explain why in the financials as we go further on. So one of the first things to kind of highlight for Procter & Gamble here, which I do think is actually a relative marginal strength, is the return on invested capital actually has been creeping up over time and will not super high compared to a lot of higher growth companies. Increasing to 14% is pretty good, and they do basically have a relatively low average weighted cost of capital of sitting only around 6-7% right now. So I think this is overall a good positioning basically for the company that at least when they are reinvesting into the company or doing acquisitions, it does seem to be getting some like all right returns, and they actually do have the opportunity to do potential acquisitions in the future actually at pretty good prices according to this weighted average cost of capital. So when we get into basically looking at the revenue, you can see the revenue actually has been growing very slowly. It did, dip basically down in the past, but then, since 2016, it has slowly been ticking up. But you can see how slowly it grows. From 2023, we're talking like, 82 billion to 2024, 84 billion. And there was only like $200 million growth from 2024 into 2025. And then with the current year, which is not fully done yet, I think it's just one quarter basically off. Well, that's 86. That's a little bit more growth. And the gross margin is maintaining very well. It's sitting at 50.33%. So they are, even though they're growing slowly, they're able to actually maintain their pricing power they have and their margins, which is important for basically companies like this. Since typically if there was more deterioration happening in them, we would probably start seeing this tick down. But you can see looking at least at the past 15 years here, 50.33 is on the higher side of things there. So this is quite good to see that the growth is starting to pick up a little bit again, and they're actually still maintaining a very good gross margin. The next thing I really do like about Procter & Gamble here is the operating margin as well. And you can see over this longer term here, the operating margin has been going up, meaning as they're actually growing their revenue, and even when their revenue basically is flat year to year, they're able to be increasing their selling and general admin expenses and other total operating expenses at a slower rate than the revenues increasing. So this is a really good sign, and this is one thing that is going to basically drive a little bit of higher EPS growth going forward in the future if they are able to basically keep raising this operating margin. But at some point, it probably is going to flatten out a little bit. And actually, it looks like that might be happening already. If we look at 2021 here, it was 23.63 and we're 23.24. So the previous operating margin expansion they basically had from the past may be kind of, normalizing out at this point. We may just be seeing something more in the future, kind of between maybe 21 or 22 up to potentially 25% going forward. The next thing basically is the interest expense, and they actually do have a lot of interest income at the same time. So their net interest expense is only $425 million, which is very, very low in comparison to the operating income of $20 billion. I usually like to say, look for at least a 1 to 10 ratio to kind of have a healthy, interest expense to operating income ratio here. And they're way above that. So they could still be looking pretty good, even if they're paying, $2 billion a year in interest expense. And that does leave the opportunity for them to do more acquisitions in the future, since they are a, very predictable company, and they would very easily actually be able to get financing for a lot of debt if they needed to at fairly low interest rates, and with a basically healthy balance sheet, as we can already tell from the income statement here, due to the low interest expense, they would be able to get it at a very favorable rate, in my opinion. The next thing, we can basically go down, we can just look at the bottom line here, and you can see they have basically steadily, again, been able to increase that net margin basically over time. And at the end of the day, they've been around this 18, 19%. So we should probably expect it to maintain there going in the future, since that seems to be what it's stuck like for the last few years. That's leaving them, $16 billion, which is, growing. Their EPS is growing at a little bit faster rate. You can see they basically do buy back the shares. In the last few years, it hasn't been basically as much, but this is something they steadily do is they buy back a few shares as basically time goes on. So overall, it's other than being a slow grower, actually everything is looking very good on the income statement. It's other than a slow growth, or gross margins are maintaining, the operating margins basically were increasing, and now look, they have stabilized, they have low interest expense. It looks pretty good overall. And you can see on the other interest income here, they have had some write-downs in the past. And when we get into the balance sheet, I'll point this out a little bit as well. And companies that do acquisitions like they do is something you basically have to kind of keep track of if they actually are doing good acquisitions or not. So getting into their balance sheet, we can see they're sitting on total current assets of 27, almost $28 billion, and probably basically from their, the cash basically and cash equivalents here, this is probably where they're earning all that interest, because they're sitting on $12 billion, which is, quite a bit of money there. So that's basically helped covering a lot of their interest expense. And we compare that to the total current liabilities. The total current liabilities actually are a bit larger, but I always do say for larger, more predictable companies like this, the current ratio is really not very important, since they basically have their accounts, payable here, and that's really what it's largely made up with. But they don't have to pay all their suppliers right away, and they probably basically have actually the whole cash flow already sorted out for this. So we don't have to pay your suppliers, and you can invest and earn some interest. Well, you should do that instead, and that's basically what Procter Gamble is doing. And we do see their total assets basically sitting at $128 billion. Compare that to the total liabilities, well, only $73 billion, because we can see the long-term debt, well, it is $23 billion. Their interest expense on that is very low. Without doing the math, I can probably bet they have just a little bit over a 3% rate, as most of these very large predictable companies that did have debt locked in before interest rates increased a lot do have it at very favorable rates. And that's a lot of the time basically why they don't pay down the debt, and they're actually investing right now the money themselves in the treasuries, because they can earn a higher interest rate than their debt. So that is something to kind of not be worried about when companies actually aren't necessarily paying down debt that they have at favorable rates. And that's leaving total stockholder equity of $54 billion, although we do kind of have to start factoring in the intangibles and goodwill. And I think for a brand company like Procter & Gamble, there probably is a lot of value in patents and everything in their intangibles, but they do have a lot of goodwill from their acquisitions they've basically done over time, sitting at $41 billion. So while they do basically have some positive equity on the balance sheet, and it's not really looking at the $54 billion, we're looking at a little bit over $10 billion. And definitely the goodwill, if you actually look back in basically the 2011 here, it was sitting at $57 billion. So over the time, they have been doing a lot of write-downs of their goodwill basically as time has gone on. So, that's kind of one of the reasons not to, kind of factor that into the total equity. Now, if we compare that to the market cap is sitting at $329 billion. So that doesn't really add any plus of extra value on their balance sheet, in my opinion, basically, compared to their overall market cap. But overall, I think the balance sheet is, relatively standard and healthy for a big company like this. The most important thing is they don't have a lot of long-term debt basically for the type of company they are, and their interest expense is very low. And if they really want to do a big acquisition, they really actually could lever up a little bit more. But you probably should expect their goodwill to decrease in the future as they do write it off, as they have been writing it basically off in the past. Which we can now see kind of what they've been doing in the past, with the purchases of businesses up here, that they do these little acquisitions and sometimes larger ones basically over time. And it's actually been a few years since they've done a larger acquisition. So this is something they may be kind of like looking at doing in the future, sitting, in a good position of their balance sheet. They haven't really made any big acquisitions in the last couple of years. Maybe they're gonna, be eyeing one shortly. But the first thing to look at, other than that, is look at the cash flow for depreciation and basically compare this to the purchase of plant, property, and equipment. And the one thing I'll point out is basically in the past year, where a lot of times it was a little bit higher, which is kind of something you'd expect for a growing company. But the problem is Procter & Gamble is not really a growing company, in my opinion. The 3% is really just with inflation, and the amount they're actually basically repurchasing and purchase of plant, property, and equipment above their depreciation is at a little bit of a higher of a rate. Like in 2020 and 2021, it was about even, but then it's kind of like accelerated up a little bit again. So what we kind of do see on the net income, you do have to factor in that because they are having to replace very consistently at a higher rate than they're depreciating, their actual net income on more of a free cash flow basis is a little bit lower than what is being stated. And you can also see they are having to spend a little bit of money to basically invest in the purchase of businesses, doing these basically acquisitions over time. So this is one of the little bit of a negative, I would say, because I just think that the amount they're having to reinvest is consistently is a little bit higher than you would expect to actually be depreciated for the slow growth they're basically having. And other than that, we can kind of see basically their free cash flow the last few years, since 2020 has been hovering around, $15 billion, which it is currently right now, which most of this is paid out basically through a dividend. They have raised the dividend over time. This is starting to basically consume a larger chunk of their cash flow, about 2/3 of it right now. So, well, they probably will continue to raise the dividend, or you probably would expect them to do so in the future. They may not be raising it as quickly in the future, and maybe very small incremental raises, which if you're a dividend investor, that's kind of important to realize, or they, potentially may pause it, because if we look at the cash flow from dividends and then also look at the repurchase of stock, they're kind of basically maxing out 100% of their free cash flow right now between the purchase of dividends and the repurchase of stock. And if they were to basically keep upping their dividend rate here, they're going to have less and less stock they're basically able to buy back at the same time. So that is one of the reasons I think the dividend basically cash, like the dividends they issue, may actually basically slow down over time. They're not going to lower it, but I wouldn't expect any big increases basically going forward. And you can see, for example, from 2015 here to almost 2020, there's this almost basically no raising of the dividend. It was raised a little bit, but it was almost completely flat. And then basically since then, they actually have kind of gone through quite a big cycle of raising the dividends again. So this may kind of be signaling that they will be slowing this down shortly in the future or in the next few years. And other than that, we can basically see, I just want to see the net issuance of debt here. You can basically see they're kind of keeping their debt basically more neutral. Like I said, they don't really have a big incentive to pay down their debt because it's at a fairly low rate. Basically some years because you got 3 new bonds and this, that, or whatever, reissue them. Sometimes basically they're basically issuing more than they're paying, but then the other years they're paying more than they're issuing. It's kind of just balancing out. So there's nothing, too much basically not happening there. So let's get into the interactive chart here, get an idea for the relative valuation, which is kind of really the main thing that's important for a company like this is, actually how much you should pay for it. So you can bring up the revenue with estimate again. You can see it's basically growing at about that 3% rate. And we bring up the EPS without non-recurring basically income. We can see it's basically growing a little bit faster at about 5%. And I think one thing to basically take away with this is applying some level basically of share buybacks to actually have it at this much higher rate, or operating margin basically expansion, which both of those, as we were just discussing before, may be a little bit unlikely to happen exactly at these rates. So I think these analyst estimates may be a little bit more aggressive because they're already basically paying so much in dividends. There's a limited amount of free cash flow they're going to be able to use to actually buy back shares. And also the operating margins, well, in the longer term trend, they have been increasing. it does actually seem to have stalled out a little bit over the last few years. So those are the kind of the two things. Well, it's really operating margins. You would need to see that they start trending those up again if you actually want these EPS estimates to be able to hit. So anyways, I think those are a little bit potentially on the aggressive side there for. So let's basically look at the PE ratio, get an idea what it's been in the history, and we can bring in a little bit shorter time frame. You can see it's sitting 20 right now, and compared to the last 5 years, there was many times it actually was trading higher before, up to 30. 25 to 30 has been like a typical upper range for it. And now that it's down to 20, you can see that the stock actually hasn't moved very much at all in the last 5 years once we kind of factor in basically having just a little bit lower PE and trading at these a little bit higher valuations. And then, pre-2020, we kind of look, it was trading more around 20, 25. You did have times it did get up into like 30 again. But a lot of the time, this is about a 20 PE ratio stock on average on the little bit higher end, maybe 25, even going up to 30. And then when things are a little bit on the worst side, it actually did go down to a 10 at the bottom of 2009 there. And, a lot of other times it has been, 15 as well. And anyways, that's been pretty consistent for the PE. Now, basically popping up the price to sales, you kind of do have to look at the margins to basically adjust for this because it has been going up over time. We do know their margins have increased as well. We should kind of see right now from this 2020 range, it is at the lower end. It's kind of been trading between a 4 and a 5, and we could say probably the average is 4.5. But we kind of look at this, these times back here, it's trading around like, a 3 more average, or even going back a little bit further, just like a little bit below a 3. But I want to bring up the net margins now. And margin. There we go. And let's take out the price to sales so we can see this a little bit cleaner here. So you can kind of see the net margins have been maintaining around this 18% level. And previously, even though the price to sales ratio was quite a bit lower from this period here, the net margins were still, between 12 and 14%. So I think the price to sales ratio potentially, well, we could also tell from the P has increased at a little bit faster rate, which kind of would say to me there, is potentially a little bit of downside in compression in that price to sales ratio. The next thing to do is, especially for consistent dividend stocks like this, and also we got to recognize that they do have I think a little bit higher dividend payout ratio right now. Basically, it is sitting around, 3% dividend yield, and historically this, maybe in the last 5 years, it's relatively looking like a good dividend yield. But if we go back basically pre-2020, a lot of times they were pushing closer to 4%. And as I go over in a lot of these videos, when you get these consistent dividend pairs like this, and you were to buy it basically every time there was a spike in the dividend yield, you would pretty much buy the basically bottom every time. But I would say right now, this does not really look like actually a very high dividend yield. There definitely is more room for the dividend yield to move up, and therefore the stock to move lower. And just on the valuation front here, I'll get into my basically just looking at the price of the stock here and what kind of the projections by the EPS are to kind of show what the type of growth rates you could get investing in the stock right now. And we can see right now basically the EPS is estimated at a compound annual growth rate of 5.1%. And as we discussed, those could be a little bit high estimates. And if you were to buy it now and expect kind of eventually to get back to a 20 to a 29 PE, at the end of 2030, you really only would be looking at maybe this 9.5 to 13% growth rate with basically the multiple expansion, which in my opinion basically is not very attractive, considering I think this is a little bit of a loftier compound annual growth rate to basically reach. That is one reason I kind of would be expecting, I would be wanting to buy the stock at a little bit lower price. And if we get kind of into the technical analysis here, the chart, you can see I have this general trend that's been forming, which kind of is based on an EPS growth. The trend channel here is actually at 5.5%. So that actually even is a little bit above what the EPS growth is. So this is a kind of bullish EPS estimate here. And it's kind of sitting in the middle. And if you look at, when were the good times to buy basically Procter Gamble, it's when they get to this basically 150 monthly moving average. This has been a pretty consistent point in the past several times. And that's sitting more closer to about $120 when I think it does get a little bit more attractive. And if you kind of plug in 120 into here, you can see for a more defensive stock, a lot of other stocks that are a little bit more growthy, you kind of want higher compound annual growth rate, basically expectations here. But for a more defensive, predictable company that is looking like, quite strong and good, like Procter and Gamble, because, a lot of the financials we did look at, they look pretty good. This kind of does get at least a little bit basically more attractive, although it's not like, super high, but for such a slow growing company, that's kind of all you can expect. And another way to kind of like look at it, for example, I'll just kind of mention that if it's these rates right now here at this 13 to 17%, this is kind of more what, like, for example, Pepsi is giving right now at its current price. And one of the things I sometimes like to do is I like to kind of like, compare stocks against each other, especially when they're kind of a similar, defensive companies in the same sector. And you kind of look at this like, Pepsi, the Procter and Gamble, and, they kind of cycle back and forth. And basically when the, chart's going up, Pepsi's outperforming. And when, the chart's going down, basically that's when Procter & Gamble is outperforming here. And you can kind of see it's like a lot of the things we looked at. When you got to these higher points here, when it gets to this upper range, that's when Procter & Gamble was at the really low prices to basically buy. And right now, basically sitting at the middle, this doesn't really look like it's favoring basically Procter & Gamble too much. And that is just kind of, one way. If I were to put my money in Procter & Gamble right now, or Pepsi, I actually do own Pepsi myself right now. That is one of the reasons I'm invested in Pepsi. And I have looked at Procter & Gamble in the past, but I just don't see it as a very, attractive valuation right now. But I think if it did get down to about $120, maybe a touch lower, that's kind of when I would actually start finding it, very interesting for a more defensive stock to buy, since, there actually would be a fair bit of upside even in the short term, or even from, like I was saying, the 5 years, you compound on your growth rate, getting, above 15%. For a defensive company that, is a good position like Procter & Gamble is not too bad. And even just, if you got a quick recovery from here, back reverting to the mean, that is like, a 30%, 36% upside to basically just recover back to, more of a fair value trend. So anyways, that's my analysis on Procter & Gamble. I hope that gave you a few insights. Remember to subscribe to the channel, like the video, and I will see you in the next stock analysis.